How would the kids handle getting a check for $2 million? Have you coached them on any of the values around that? That stuff doesn't get covered. So how do you tailor your estate plan so that it's taking account for the individual natures of each of the kids?
Most people think a will and a trust is enough, but Steve Gibbs has spent his career uncovering the gaps that exist in almost every estate plan and how to close them.
I don't think people always pursue peace of mind. I look at it in three ways: the strategic side of it, the tax efficiency, and you have the people. And this is something the wealthy know very well.
Steve reveals what most professionals miss when planning their estate, how to solve the liquidity problems that cripple wealth transfers, and the power of infinite banking to maximize what you pass on without retirement destroying your life's work.
With infinite banking, you could put money into a contract where it can grow consistently tax-free, that then becomes very powerful for the next generation.
Protect your estate and leave more behind for your heirs in this episode of the Dynasis Podcast. Most families, when they think about inheritance and passing something on, the first thing that comes to their mind is a will. But what I've noticed with a lot of the more astute families, let's say, is that they do something different with their estate planning. So what separates good estate planning from just having a will in place?
Yeah, thank you. Good question. And I've dealt with this question foremost of probably any other question throughout many years. The fact of the matter is, a will is good. Everybody says you need to have a will. If you don't have a will, then the probate court, whoever is going to make the orders and decisions about your estate, they won't have any directions whatsoever. So the will is just I call it an instruction sheet for the probate court. And so it's very basic to your point. And you want to have it. If you're not going to have anything else, you at least want the court to know, I want these assets to go here, and I want this person to represent my estate, and so on and so forth. And that's what a will does. It basically appoints a person to take care of things as a business function, and then it doles out the assets to certain people, loved ones, friends, whoever you decide. So yes, you're touching on a related point, which is what do more sophisticated planners do, what do wealthier households do in these kinds of questions, correct?
Mm-hmm. Yeah. So What do they do?
So trust is a obvious one, right? You've heard of living trusts, and anybody listening, if you haven't heard of a trust and using it for estate planning, it's basically a contractual way to plan your estate. So you're gonna create this trust, and it's a contract, and you're gonna appoint somebody to take charge of that contract, a little bit similarly to when you appoint a business person under a will, except with a trust, you call that person a trustee, and they're actually contractually authorized to manage all the assets that are inside of that trust. So then what the wealthy do, what people do for sophisticated planning, is they'll title the assets into the trust, which means that you transfer the title to the trust. And that way the trust has those assets within it and can then pass those assets directly without the probate court. So what you're really doing is you create a trust to sidestep, number one, the requirement of probate. And there's all kinds of different debates. If you were to go in and AI, do I need a trust? There's going to be different opinions on that, depending on your situation, the size of the estate, the state that you're in is kind of a big deal, because some states have more options for probate than others. And so it gets to be kind of a multifaceted conversation, right? Do I need a trust? In most cases, in most states, if you own some real estate, you're probably going to benefit from a trust. You can put anything in a trust. You can put a home in it. You can put bank accounts in it. And by that, I just mean put the name of the trust on those assets, because the underlying backdrop of all estate planning is that if your name is on something, Ben, basically that's going to have to be renamed upon your exiting the planet, so to speak. So a court will have to do that if it's not in a trust. So the trust puts the trust name on it, and then the trust contractually can then pass those assets to where they're supposed to go more efficiently than having it in the probate court. And it's also more private. You're going to avoid the probate fees. Timing wise, it could be a lot faster if everything's set up in the trust properly. So you have speed, you have efficiency, privacy. Those are the reasons why people use trusts typically.
Okay, so just stepping back a bit, what happens if you don't have a will?
If you don't have a will, then everything in your estate has to fall back on state laws. So basically, then under state laws, they're going to say that typically, the spouse has rights to certain assets, especially jointly titled ones. And then you're going to have the heirs, right? Kids, adult children can typically get assets, but it's very inflexible. I mean, it is what it is based on the relationships that you have. If you have anything going on at all that's atypical, second marriage, um, adult child with special needs, something like that, anything, the state laws are going to be not going to be effective. And even when you don't have anything odd, chances are you might want to do some different things other than just what the state laws are allowing. So they call that, laws of intestacy, succession, very old school, lots of hard to understand language with the way that assets are supposed to be distributed down from generation. You hear these terms like per stirpes, per capita, in just different states. And so much easier to actually have a will to offer those instructions.
So, what level then do you need to start thinking about putting a trust in place instead of a will, or as well as a will, rather?
Right. That's a question that estate planning attorneys would probably debate a little bit. But I think a good rule of thumb is if you have some real estate, some states like Florida, if you have a family home, you may not want to put it in a trust. So it gets a little complicated. Florida has something that's called homestead laws. Different states have different laws related to a family home. So there could be situations where you don't put your family home in a trust. In most cases, if you have a family home, you're probably going to benefit from a trust in most states. So, and in addition, if you have any other assets, if you've got any other real estate, definitely you're going to benefit from a trust. Then you're getting into situations where you're going to have lots of assets in probate and really a bogged down situation in probate. The other thing, so you have it sort of depends on your assets. The other thing is special circumstances. So if you have, like I said, a second marriage, if you have any of your children that have special needs that need a trust put in place for them, if you have younger children, you're going to want to have some kind of protection in place. And a lot of times that's a trust. This gets more complicated because you have things called like a testamentary trust. So you could put a trust inside of a will, which is a different animal than a standalone trust. So we can unpack some of that if you want, but I don't want to get too far into the weeds, but just to say, if you have kids, trusts, most people are thinking about trusts. Trusts are beneficial.
Just jumping in here to remind you to like and subscribe. It only takes a sec and helps me bring more world-class guests to you to help you build a legacy family. Also, this episode is brought to you by me, so check out the links in the description to access my library of essays for elite families and consider upgrading if you want to support my work and get full access and additional perks. Thanks, and back to Steve. What are some things that should be considered when you're planning a trust? Like you've mentioned that real estate's one of them. What about things like businesses or, say,
Yeah,
stock portfolios or something like that?
sure. I mean, if you have a business, you're most likely, maybe you've talked about, and to your listeners, having an entity of some kind. Maybe somebody has an LLC, maybe they have a corporation. If there's no planning and put in place around that business, then it's going to be unclear as to where that goes if something were to happen to most business owners. Sometimes you have partners, so you need to do planning between the two business partners. You might do something in the LLC documents themselves. Like it would say, if anything happens to me, my interest goes to my partner. But most of the time, you have a spouse. And so then you're going to bring a trust into that planning process as well. So you might say, and everything is about the documents. And, you know, AI is becoming very sophisticated with some of this stuff. So if you were to ask AI, what do I need to do with my business? It'll probably give you a pretty good explanation at this point. But I think where the skill is connecting the dots. So if you have a business, then you're going to want your operating agreement, if you have an LLC, or your shareholders agreement, to point back to your trust somewhere along the lines to say that your spouse can inherit your business equity, or that there'll be a buyout. You just want a plan. So if I'm trying, and I always try to keep things simple these days. It wasn't always so. So I would get in the weeds, especially as a younger attorney. And attorneys get in the weeds all the time, by the way.
Yeah.
So I try to keep it simple. If you wrote it out on a napkin, and you wrote your business over here and you wrote your trust over here, and then you had all your loved ones at the bottom. You might have an arrow going from your business to your trust, right? And then you have an arrow going down from your trust to your loved ones. And that's a simple way to describe it. So you want to avoid probate with those businesses. If you have stock, you're going to want to put probably your trust name on the stock so that you don't have no owners and then you have to put the stock through probate. There's a lot of ways to try to get around trusts that you're going to come across out there. So you're going to come across, transfer on death provisions, where you've maybe heard of a bank account and you do a POD on it, or transfer on death. You can even have deeds that have transfers on death. So the question is, when you draw everything out on your napkin, do you want to, if you have a piece of property and you have a transfer on death, it would mean that in the deed it said that my wife gets this property, or my kids, and you put an arrow right down. So what I would recommend for your listeners is just to say, can I write my estate plan out on a napkin, so that, not that I recommend you write it on a napkin, I'm saying
No.
as a
No.
strategy, because it won't work.
Yes.
But as a strategy, can I chart out the course on a napkin and say, so if I have my assets over here, my business, my real estate, my stock, how's that going to get down to where I want it to go, right? If it doesn't come directly like an automatic transfer, then it's going to require a court. So you want to do it outside of the courts, if at all possible. And the way to do that
Right.
is automatic transfers on death, which depends on the asset, or you do that through a trust, typically. So you have to do it contractually if you don't do it through a probate court. Simple, right? I mean, you need a contract.
Simple when you've been doing it for 20 years.
I know. So I really want to explain it. I mean, if you and I were just chatting in a coffee shop, right, I would explain it to you that you need to figure out the mechanism that asset is going to go down to your kids, and you'd rather avoid the judge, right? So the way to avoid a judge is to have a contract or something legal that specifies what is going to happen and who has the authority to do it, and that's a trust. It could be an operating agreement in an LLC flowing to a trust. It could be a transfer on death, like your bank account could go automatically to someone if you put a transfer on death on that bank account. But a trust is probably the best way, because even with transfers on death and these kind of things, we're entering a time where banks get skittish. They might not want to honor a transfer on death. They might think that it's going to be challenged. They might think there's going to be, I've had that actually happen in my experience. So, yeah. So that the caveat on that is, if you want to try to avoid a trust and you think something is going to be really simple, you want to make sure that you have a pretty good idea that it's going to work. So.
And simplicity obviously makes that more straightforward. But in terms of the trust and their structure, are they bulletproof from the start, or are there some things that have to be put in place to help make sure that they're airtight? Is it possible to break a trust, or what's sort of the the protections around it?
Yeah, that's a great question. I think I would be very hesitant to use bulletproof about anything. I think people love the word bulletproof, especially people that are peddling some kind of special trust that they created. But the fact of the matter is that trusts are harder to break. They're harder to mess with than a will would be. So, because a trust is a contract, there are states that you can put a no contest clause inside of a trust, so that any heir that would challenge that trust would be deemed to not get their share. And so some states will allow that in order to prevent litigation around trusts. Some states don't allow it. Florida, for example, where I practiced for many years, Florida did not allow it. It was actually not enforceable under a trust. So that you really want to know, in the AI world and in the world of people giving trusts out from online sources, you want to know that being lined up and dialed in according to the state laws. If you put a no contest clause in a Florida trust, it's just not enforceable. So, but to your point, they are harder to break. A trust is harder to break than if you were to go into court and challenge a will. One thing about trusts is that you have to actually file a lawsuit and drag the trustee into court, where a will is already in court because it's in the probate process. So you could appear, challenge a will fairly easily, and it's harder to do so with a trust. So
Right. And so the court obviously complicates things. Do they have like some kind of I mean, feels like everything in America has some kind of a charge attached, but does the probate court have some kind of cost attached that deduct from the will at all, or from the inheritance / estate?
absolutely. Yeah, and you're right. Probates are expensive. They actually have a statutory fee structure, I believe, in pretty much every state, where they can have it be fairly nominal for a real small estate. And then a lot of the states graduate the statutory probate fees up to very, much higher. As the asset values increase, then it's going to get rather involved. So you can have probate fees easily ranging into the 35, 45, $50,000 just to run the
Wow.
probate if you have some assets in it,
Mm-hmm.
and that's, attorneys love that. There's plenty of U.S. attorneys based in the U.S., I should say, that they really would rather have probates than do trusts because of the
Mm-hmm.
economics of doing probates. It's just very lucrative, and trusts not so much. I mean, you might pay $5,000 for a trust, to have it created. You might pay a little more than that with a bigger firm or something, 10, maybe 15,000 tops if you have a big estate. That's a lot less than what a probate's going to cost, even for a fairly, nominally sized estate. So,
Are there ongoing costs involved with trusts? Like when you have an LLC, obviously you've got to file it, and
yeah,
at least here in New Zealand, we have to register it every year,
yeah,
file taxes, things like that. What kind
yeah.
of costs are involved with the trust?
That's a great question. Typically, it's a private contract. You don't have any filing like that. You don't have any state requirements. Think of it more like a private contract as opposed to a state entity like an LLC. So an LLC or a corporation is a creature of the state. A trust is a creature of private contract. However, there may be attorneys that decided they're going to charge an annual fee to maintain it. You could, depending on what attorney you get, you could be signing up for something kind of expensive that perhaps you might not need. You can, that's not something that I did. There were attorneys that offered maintenance plans. They offered the ability to update the trust, but really what you can do is you can pay for your trust and then pay an attorney if you want to update it. And people get weird about that, but it's actually cheaper probably to have your trust, leave it alone. And if you want to make updates to it, just bring it in to the attorney, pay him to update it, and go that route, because there's really no other maintenance costs that you have. So
Right. Okay. So we've talked about wills and we've talked about trusts. Are there any other structures that exist out there? I mean, you've talked about transfer on death as well. I don't think it
right.
necessarily qualifies as a structure, but is there anything else that can be put in place?
Yeah, that's a fair question. I think actually transfers on death are a structure. They are. I mean, they're a method, right? They're a method that people use to transfer assets. There are states that have transfer on death deeds. So instead of doing a trust, you can do a deed that says that if anything happens to the principal, that deed will automatically transfer to certain people in certain shares, whatever you want to do. Florida has it. I'm sure many states are now using transfer on death deeds. There's also little hybrids of that. There's what we call Ladybird deeds, which are used for having the right to transfer. So what will happen is, like, mom or dad may do a deed that gives them the right to sell the property, but if they die, then the property would still go to their kids automatically. They call that a Ladybird deed. I believe it has something to do with Ladybird Johnson. I have no idea what the actual connection is to her, but they call that deed in sort of a vernacular. It's an enhanced life estate deed. So the problem with transfers on death and life estate deeds is that you can really you can get into trouble because if you don't have a ladybird deed, and you gave a remainder to somebody, like say I said, if anything happens to me, you get my property. If I want to thereafter sell it, I might have to get your permission to do it because you have a remainder interest. So you want to be, I only say that not to complicate it, but to say that you just got to be careful about what kind of planning you put in place. So you think about down the road. That's why a trust is good too, because if you ever want to change your trust, you're the only one that has to approve that. So you don't have to get your beneficiaries to approve a change in your trust. So yeah, but you have transfers
That
on
was
death.
actually one of my questions.
Yeah, yeah. So you have transfers on death. It's a structure, transfer on death deeds. You could put a TOD on your bank account, so you could to say that your personal bank account will transfer automatically. And there's lots of different things you can do. And of course, you have life insurance too, which is a big focus of mine these days. Life insurance is a contract. It's also a trust in a way, but we can venture into that question if you want, which is how is a life insurance like a trust? It's very similar. You have a contract, you have a death benefit. So got interesting things going on there.
Oh yeah, we'll definitely dive into the life insurance side a little bit later because that is of immense interest to me as well. As I get to the point where I can't avoid calling myself middle aged anymore.
Right?
But another question that I had around this is private family foundations. Are they similar to a trust, or is that something that somebody a wealthier family should look at establishing, or how does that work?
Yeah, I think everybody in the ultra wealthy world, I'm sure, probably has one. It's probably like the average person has a coat. They have foundations. They're used for raising money. They're used for charitable work, tax advantages around those foundations. And I can't claim to be an expert at family foundations. That those are, I wouldn't necessarily call those a function of estate planning, except as you're talking about taxes. So when you get into wealthier families and the planning that's going on there, get into a lot of generational tax planning. So, and they use trusts. So you could put, you can have foundations inside of a trust, and you could have these generational trusts, right? Because that ownership interest in the foundation is going to pass in the same way that you might have a corporation or at a simpler level, an LLC. So, so yeah, foundations are used and they're used for tax advantages that are fairly complicated. If you think estate planning is complicated, and you get into those, nonprofits are also used, and nonprofits are complicated as well, just because of all the tax laws. But there's deductions for putting money into those. There's a lot of donation rules around foundations, and so it's a way to store wealth and raise money and keep money in a vehicle that is separate from the individual. And so if you have a bunch of money in a corporation, it's a similar thing. And then who gets that corporation, when you're no longer here to hold the shares, who gets the shares? A similar thing can be happening with foundations, interest, nonprofit interest, it's stock, it's ownership. Everything is sort of simplify everything, right? I would write that on the napkin too. I would just say foundation, who gets that, in the event that I no longer can hold my interest, or if it's in a trust, then that trust is then going to determine who the owners are of that entity in that next generation. So
Just a hypothetical that comes to mind before we get off the subject of trusts. What if you were to set up something like a corporation and you were to put your and your wife's name on it and have your kids and parents were to contribute some wealth into it every year, and it just did something simple like purchase real estate, or maybe it was rural land or stocks, or something that wasn't necessarily an operating business of sorts, or not in a traditional sense, and then gradually hand shares over to their kids. Is that like something that would work in terms of facilitating an early transfer of wealth?
yeah, it sounds like maybe you've been exposed to the idea of using a family LLC or a family limited partnership or something like that. And that's exactly what a lot of wealthy families do. So what they're doing is they're creating an LLC. It used to be limited partnerships. Now it seems to me that they're more or less using LLCs for the same reason. They're cheaper to do. They're a little more flexible. You don't. So what you do is you have your main managers, right? Mom and dad probably, and then you can be gifting. So they use gifting for tax purposes. I don't know how it is in New Zealand or Spain, but but you basically are gifting out of that, and you can discount it because they don't have as much control as you do and things like that. So then you can gift however many shares, and they call it units of membership interest, gift it to the kids and then discount it. And that's a tax calculation. So let's say if the LLC is worth $1 million and I want to gift the kids 10% of that collectively, then maybe it's worth 100,000, but they'll discount it. So maybe the gift is like, 60,000 or something like that, or whatever decided. What that does is it helps push assets out of your estate, and so that you're not getting hit as badly on estate taxes. So estate taxes is a whole other complex animal. It's basically if you have over, say, roughly 30 million in assets right now in the US, then you're going to get hit with a 45% tax. It's a wealth tax is what it is. So, but that's a pretty good threshold. I mean, it's been down low. It's been down to probably 3.5 million, I think, maybe less. And maybe it was down to maybe 1.5. But so we're at a really high threshold for a wealth tax right now. So that's not as popular. People aren't really caring as much about like gifting. It was super popular when it was low, So when the exemption amount was low. So if it were over 3.5 million in assets and then my family is going to get taxed, I'm going to be doing everything I can to get the assets out, right? I want to get them to the kids. I want to discount them. I want to gift them, whatever I have to do, because I know there's going to be a huge tax on my estate. Well, it's 30 million now, so people aren't, only the ultra wealthy are really trying to do as much of that. And they're probably doing it through foundations, through different kinds of things to get assets out of the estate that way. So,
Okay, I was actually aware of that. So, how do the estate taxes work there then, or the death taxes? Let's call them what they are. How the death taxes actually work over there?
Well, they're around a 45% tax, and if you don't have planning, there's been some notorious cases where people get hit hard in estate taxes. I think the Miami Dolphins case, Joe Robbie, I think there was a big debacle with trust planning there. I'm not sure if that one created huge estate tax complications, but here's what happens. That tax is due really within 9 months of death. And so what happens is there's a liquidity problem. So if I've got a bunch of real estate and businesses and stuff, and they're way over the threshold, what will happen is the court will say, or they'll say, where's our tax? And if the liquidity is not in the estate, then there's going to have to be a fire sale of some kind. So liquidity meaning cash, right? Meaning the ability to pay bills. So if you don't have it, then you have to sell assets at that point. And it could be a fire sale situation. And so, but the way that it works is that it's a tax that's due within 9 months of date of death, and it's a percentage of whatever the amount is over the exemption threshold. So if it's 30 million and somebody has 50 million in their estate, you're going to owe a tax for roughly 20 million, 45% of that value. So you're talking, whatever 45% of 20 million is, that would be, you can do the math on that real quick, but is roughly 9.5 million, something like that.
Something like that, yeah.
So it's pretty hefty, and that's at a high level. If somebody had no planning, that's what it would look like. Now, probably with sophisticated, wealthy households, years prior, they're trying to offload that. So they're trying to put that into irrevocable trusts and gift it out. they're trying to gift it to kids or in different heirs. Um, they're looking at trying to and putting it into entities, and gifting it out that way. A family LLC would be another way to keep doing that, gifting it out, discounting it. And so you want to get your estate down to the 30 million in my example. So in order to avoid it. But
So there's no taxes before that 30 million.
not from the wealth tax standpoint, not from the, yeah, if you're inside of the exemption, and don't confuse income tax with estate taxes, right? You could have tons of different things happening on the income side. Now, life insurance is not taxed from an income standpoint. It could create, and well, the idea is that it's not going to be taxable from the, well, it would be taxable in the estate unless you use a trust. So there's things about, like all that money that's getting paid out is subject to tax. So
Right.
yeah, you're doing a lot
Okay.
of, yeah, the idea is to get it inside the exemption and avoid that. Typically, money coming out of an estate is not taxable, but I'm not going to say that in every state they're never going to get taxed for income purposes on it. That's a tough one
It's the
to
kind of thing you can't write on the back of a napkin.
yeah, that one's tricky on a napkin.
Yes.
To me, life insurance is the best because it's completely liquid. There's no tax on it from an income standpoint. 401ks and IRAs can be problematic. Real estate is good from the step up in basis standpoint. And most of the time, a cash gift is not going to create a tax complication unless you have something going on in that state. There are states that want to tax more, some states more than others, obviously.
There are
So
countries that want to tax everything, so it's
yeah,
it's a very complicated subject. But we've kind of danced around it now, but I think now's a good time to get into it
okay.
with life insurance. Now, one of your things that you've talked about semi-frequently is infinite banking. Is this tied into life insurance, or how does this work? Because it's one of those things that kind of solves that liquidity issue, isn't it?
It does. It solves the liquidity issue better than anything else because it's just liquid cash coming into an estate, and it's one of the reasons why the wealthy use life insurance for lots of different reasons from an estate planning standpoint. They might use life insurance for business succession planning. A lot of times when people have a buyout agreement, they have it funded by a certain amount of life insurance that is payable on the death of one of the partners in order to make sure there's enough liquidity to buy out the business. So you might have a formula that is in place for buying out the business inside of your buy-sell agreement, and then you're going to use life insurance to try to approximate what that buyout will take. So then you don't need any extra liquidity in order to make the buyout happen. So at a high level, that's a complicated way to look at how life insurance helps because you don't want to be having people that can't afford the buyout. Then what do you do with the business? You got a problem. So, and in the same way, if you're looking at estate taxes, at the very least, you could fund up the liability with life insurance. So you could say, we think we're going to owe 10 million in estate taxes. You want to make sure you have enough insurance to cover that. It's sometimes what wealthy families will do is they'll just make sure that they're covering that any liquidity needs with insurance. So as far as infinite banking, what infinite banking is a strategy and a system that is used within the parameters of certain type of life insurance that we talk about all the time. So it is useful for estate planning from the standpoint that with infinite banking, you have a growing death benefit that is funded by ongoing cash value growth during the lifetime of the person. And that creates a growing death benefit that then satisfies liquidity concerns upon death, takes care of loved ones, and also perpetuates the legacy planning aspect of what people want to do. So from an average household kind of standpoint, which infinite banking can work for average people, it can be very beneficial for the wealthy. So we talk about it across the economic spectrum. If somebody's got a budget of $1,000 a month But if they're living within their means and say they spend 500, maybe they want to put 250 of that into an infinite banking policy over many years. Again, these are just very rough numbers, just for example. But what that will do is that gives them a few things. It gives them safe capital that is not subject to the markets, which can be wild. And we're seeing it right now at the time of this recording, and we're seeing very radical wildness in the markets. The silver thing that's going on, the Bitcoin crashing. People always they always think, oh, your life insurance thing isn't very cool until everything else is collapsing. And then they kind of think, man, I wish I had one of those policies right now. So that's what we're talking about. So we're talking about putting money into a contract, right? Which I mentioned, I equated it with a trust. You have this insurance contract, and what infinite banking is, and we call it high cash value whole life, which is about storing cash within a contract. And there's specific tax provisions around it in the U.S. that are called 7702 of the IRS code. What that does, it allows you to put money into a life insurance contract where it can grow consistently tax-free over time with the type of company and policy that I'm referring to, which is high cash value whole life from a mutual company. A lot of people in other countries contact us and they say, can we get this in these different countries? And it is, I think, the US, one of the last sort of places that you can get it in Canada, and I'm not sure about the UK, but basically it's this: when you have a mutual company, the policy owners are the policy holders are the owners of the company, and so you get this contractual growth, but you also get dividends, which is a return of premiums. So you get this tax advantage growth, okay? And people get confused about it and debate it, and you have financial entertainers that kind of try to detract from it. And we always take the position they don't understand it. They don't understand what it means to take this is a regular whole life policy that we put on steroids by creating an ability to put more cash value into it. So we reduce death benefit, we increase the cash value holding capacity, and there's things called MEC limits, which we want to stay within. So, because there's regulation around life insurance. But the idea is that what we did is we expedited cash value growth for that family, for that person over many years. And what that does is it funds an increasing death benefit that then becomes very powerful upon death for the next generation, because you got the liquidity that we were just talking about, going from one generation to the next, tax-free, completely flexible. And then you could also use a trust. So we're back to a trust. So instead of just paying the kids, right, that death benefit or whatever, you can have that go into a trust where a trustee is overseeing that and then managing those proceeds for the kids. They can go out, use some of that to get their own policies. And the idea is we're creating generational wealth in a very powerful way at that point. So what we're trying to do is we're equipping your average people with the ability to accrue and maintain generational wealth, rather than just saying, well, this is all we can do. All we can do is invest in the markets. All we can do is, pay whatever is owed and probate and all this stuff. So it all goes together. So for me, when I was practicing as a trust and estate attorney, I had some conversations with my uncle, and I wrote a lot about this in my book, The Self-Banking Blueprint, which I think you've been a little bit familiar with, Ben. I don't know if you've read it. You don't have to tell me, but what I wrote about is my introduction from my uncle, who was working for one of the big companies in the mutual whole life space, and he shared some things with me at a young age, and I saw it. What I thought I was I didn't have a lot of knowledge, but I thought, well, that's really cool that you could put money into a contract and you could know how much money you're going to have down the road, 10 years, 15, within a reasonable proximity. I couldn't figure out, nobody else is telling me that I can do that. Everybody else is saying, we'll pay you a tiny bit of interest, or you can put it into the markets and see what happens. But so I loved that about it. And then I became more familiar with other people that had the asset. And you can see behind me the ultimate asset, which is one of our ways that we describe it. And I could see that they loved it after a certain period, after it grew and compounded for certain years. It was one of their most useful assets. And for a lot of reasons, it was useful for me from an estate planning standpoint because of the death benefit, but it was also useful for them during lifetime. It would help them with long-term care issues. They could pull money out of the policy during lifetime. They could use policy loans to fund different businesses, different investments. And so I just noticed that it was very useful and very powerful, and that there was a lot of misnomer discussions around it, such as it's too expensive, it's, whatever. And when it's designed and used in this way, it really caught my attention, and it led to everything that we do at insuranceandestates.com currently. And it's a key component for sure for people that really want to grow wealth with from the standpoint of peace of mind, and really looking down the road rather than just hoping for the highest gains in the short term.
Yeah, no, it sounds like what you're actually doing with this whole system, putting the trusts in place, putting life insurance policies, even forget the exact term, deed of transfer on death deeds. Um,
Yeah.
all these things here, it's like you're building an ecosystem that facilitates a family's capacity to build generational wealth and protect it from, let's say, agents that don't have your family's wealth in their interests. Is that a fair thing to say?
I think that's a great way to say it. The ecosystem, and it's been close to my heart. I've met with so many people, people at the end of their life, younger people are just getting started having kids. I'm grateful for the tenure that I had, especially early on, because it matured me faster, and I could see the life cycle a little bit before me, where it maybe takes some people longer to get that. And it was close to my heart from the standpoint of, I don't think people always pursue peace of mind. I think there's a tendency that people want to pursue growth, they want to pursue wealth, they want to pursue their ambitions, whatever is important to them, but maybe not always realizing that the backdrop of all that stuff is enhanced by having a home base and a peace of mind. And so the ecosystem is that. The ecosystem is having all I look at it in three ways. And I look at it as the strategic side of it, which is the documents, right? The tax efficiency side, which is kind of the liquidity and the end of, the transfer on death kinds of things. So you have your documents, you have tax efficiency, and you have the people in every estate, which are all the talent, the family. What do they want? What are their gifts? What's important to them? What are their values, right? And so this supports all three of those. You have your strategies, you have your financial efficiency piece of it. It doesn't mean you can never invest in the markets. It just means that when you have safe capital, right? And this is something the wealthy know very well, that they have a component, a portion of their wealth that's safe, and you just don't mess with it. At least with the really solid families, they're like, "Hey, Tommy, you don't touch the safe capital." It's like, you can go play around with your little stock account, but we don't mess with this. And so I like to emphasize that, and ideally this should all fuel the younger generation, the emerging generation, to be able to find what's important to them, help them develop responsibility, gratitude, and appreciation for things, and hopefully facilitate that. And that's what I have some other involvements, and that's what this wealth transfer coach thing is as well. We're in the middle of a huge wealth transfer. It should be done smart. It should be done with a mind toward the people involved. There's gaps in traditional estate planning that I haven't touched on too much, but a lot of times you got documents, but you haven't thought about the people very well, and so your documents aren't going to work very well because you didn't think about the people. So I want to just touch on that. Obviously, that's an important piece for anybody that's listening to you and thinking about embarking on estate planning. That you kind of want both.
Oh, for
Or
sure. Yeah.
yeah.
I've got a few more questions down that route, but I just want to explore a little bit more on life insurance can really help protect somebody and what kind of person it's best suited for, what stage in their life. So, is there like an age range that somebody should start thinking about setting up a life insurance policy, or is it, you turn 18, let's set it up kind of thing?
Well, the common response to that question among pretty much everybody on our team, to be blunt, is people wish they got started earlier at it. I mean, it's the younger you are when you start committing. So you want to be able to commit with a budget, right? So you don't, obviously, if you're 18 years old and you're not sure where your income is going to come from, that's not working too well. But if you have some stability, you're better off getting started young and saying, I'm going to put X number of dollars every month into my policy, and I'm not going to ever mess with it. No matter what happens, I'm going to, and it doesn't mean you can never miss a payment. What it means is that I'm going to commit to it, um, and fund it very diligently. Because if somebody can do that at a young age, that's very inexpensive. The life insurance piece of it is inexpensive, right? That's going to keep getting more expensive the older you get. So I would say, if as a way to kind of measure when it becomes more critical, maybe when you're young and start having kids. At that point, you probably want to commit, and you're going to be committed to a budget anyways at that point, because you're going to be paying for kids to be eating and stuff like that. So
Tell me
if
about
everyone,
it.
and you can fund your life insurance, right? And so I would say that would be a good measure. Ideal. I mean, if you're in your early 30s, late 20s, whatever, people are getting started earlier a little bit now. Again, in my generation, there was a delay factor that was going on for whatever reason. But this generation seems to be getting started with kids earlier again, which is great. I think it's healthier. Um, so I think it can be very good if people are able to accommodate that, even a couple $100s a month, because the life insurance piece is cheaper. And if somebody's thinking about doing it, you want it properly designed. You don't want to just be doing a traditional whole life policy, because you're going to be paying mostly for death benefit. It's going to be too expensive. So what you want to be doing is you have it designed. This is why we're here, by the way. You have it designed so that you can get as much cash value into that. And what you'll see is you're going to probably blend it with some term and things in the beginning. Term is just temporary insurance, which will drop off eventually when the policy is really kicking into gear, and that death benefit will keep growing after the term drops. But that way, what you just did is you were able to put more cash, which you can use. So let's say you wanted to, say you're, I don't know, 25, you start your policy, you want to be able to buy a house in 5 years. You could put money into your cash value. 5 years, maybe you've got, I don't know, 50,000 in there that you want to take in a policy loan to pay the down payment on your house. You took that money in a policy loan, but the 50,000 of cash in there keeps working. So you didn't sacrifice it. You just took a leverage on it, right? But it's still going to fund. So then the idea is you pay back that policy loan. You're starting to really fuel your policy at that point. So what you're doing is you're creating, at a young age, you're creating financial momentum, which is powerful for any young person. And I mean, I personally experienced the buffer that this is financially, having been an entrepreneur my whole life. And so I do recommend it to younger people for that reason, and having kids. And it just gives you, not to mention, you have a death benefit there the whole time, right? So, as you're funding this policy, there's something does happen to me, my kids, my wife, kids, whatever, and be taken care of. So you have that piece of it. Now, if somebody's listening, they're a little older, it's fine. If you're 50 years old and you realize this is cool, there's a lot of things that can be done at that age. You can start on a monthly basis. There's companies that we do lump sums into, and maybe we spread them out a little bit, but there's lump sum options. And so there's some powerful things that you can do at 50, 55, whatever. I mean, if you're in your 30s and 40s, terrific. That's all the better. So I know that's not the most clear answer, but I think the earlier the better, but there's a lot of flexibility too in middle-aged years.
So what about, you mentioned there that you can access this cash, or at least the asset value. Is it possible to, I mean, you've said leverage, but is it possible to cash out in case there's a change in circumstance, or maybe you want to move away from the States, or something like that?
You wouldn't have to cash it out if you wanted to move away. It's an asset. You could just hold it. But I believe. I mean, I haven't had anyone that wanted to move, and they do require you to be in the country when you obtain it.
Hmm.
So um, yes, it is possible to cash it out at any point. It's going to have a growing surrender value. So, and when you withdraw cash, you can withdraw cash up to basis, and there's no taxes on it. So,
Okay.
because it's what you paid in premiums, right? So, and there's a lot of strategies around that too. So you can, when in your older years, if you want to create tax-free retirement, you can draw down, and a lot of times you'll draw down cash first, and then you'll use policy loans on top of that, which are deducted from the death benefit. And so you can, and you don't ever have to pay those policy loans back. And that's a way that people set up a policy where in their later years they can get tax-free income. So they're not having to do just a 401k where you're going to be pulling money out and getting taxed on it, which people don't always want, especially if they're higher earners. So what we also coach people on is you can create a policy that in your later years can supplement your 401k or IRA, or if you have a drop, right? If you're retiring and you have a market collapse, it also is a buffer for that, so that you can keep money in there and let it recover rather than have to keep taking withdrawals out of it, because that's the trap that people fall into
Hmm.
with 401ks and IRAs. They end up in a really bad retirement situation because they didn't have anything else that they put in place. So you got all this comprehensive stuff that you can do around this.
Yeah, it really does sound like it's setting up like a hedge against, well, a lot of things actually. But what if, say, the insurance company goes under or something like that? What happens then? Is there protection in place for that?
Typically, yes. I mean, that's a good question. I mean, the companies that we use, they have really high ratings. So you've got your different standards, Standard and Poor, and different ratings, A plus, and we use those kinds of companies. They've been around for hundreds of years. We have had some companies that have experienced issues. I think AIG was one a couple of years ago that went through some things. But the thing on those is all the good companies have state backing, so they have your state funds that ensure if that company goes down, that you've got that. It's somewhat similar to FDIC, I suppose. So you do have some protections around that. The recommendation, I mean, the discussion around that is you want to use top companies,
Hmm.
and I like the policies that I hold. If one of them is Penn Mutual, if they go down, we've got bigger problems then. I think at that point, I mean, there's no, if things collapse to a catastrophic degree, you might not care. But typically, these companies, I mean, they're very well funded, they're well managed. You can watch them over the years how they're handling their stuff. If you felt that your company was going sideways, you could do what's called a 1035 exchange. So you can take your policy money and exchange it for a different company. There's a process for that, and you'd want to do all the math and everything. But we do see that. We see that with people that have policies that they weren't very thrilled with. And so our team does policy reviews for people. And if it's not looking good from a cash standpoint or whatever, we do 1035 exchanges. And that's a way to go to a different product. It could be if somebody has an IUL that's listening. I'm not a huge fan of IULs. IULs have a lot of issues that have been talked about. So it's not just me. But we have people that come with issues with and concerns with those. And we've helped people with 1035 exchanges into a high cash value whole life, which is a more stable contract. So those kind of things can be done as well if somebody's not liking their company.
Yeah, I think let's, because we're kind of coming up on time a bit here. So you wanted to talk about some of the gaps in traditional estate planning. You just want to
Mm.
expand on that a little bit?
Yeah, that's a question I love, having lived it. I know for a fact when I was a full-time trust and estate attorney, I got paid for doing trust. So, and I got paid for analyzing the family and talking to my clients about who's going to be the best person to take control of the trust, Where are all the assets going? Do you have any special needs beneficiaries? Are there any aging parents at home that you need taken care of? And I would ask them all these questions, and then I would draft the trust accordingly so that it would cover all this stuff. Sometimes you'd have more than one of the kids that was the trustee. They maybe work together, and so there are a lot of different. There's so many different dynamics in families. So, but the things that we couldn't get into, especially with wealthier clients, were things like, okay, so if you're going to sell the business probably before, and we weren't ever to talk about how would the kids handle getting a check for $2 million right now. Do you think that they could handle that? Have you coached them on any of the values around that? And you'd have people say, "Oh, my kids are terrific. They're solid," and that's great. So, but that stuff doesn't get covered. So, especially when it comes to family businesses. So, let's say that they want. Do you have any plan at all for someone to take over the business if you can't serve? Sometimes one of the kids would be slated to take over, but you know that I knew, I should say, that there were issues with the other siblings that were likely to be going on with that. Sometimes they would be weighted in one direction or the other. You know, my son John gets more than the other two because he's been involved in the business. Well, that's great, but how are the other two going to feel about that? And so the idea of wealth transfer and coaching around that, and this is particularly valuable for a middle to wealthier family, right? Because they're the ones that probably the kids are going to be most impacted. The average household, not so much. They're not going to be a head case because of having grown up in a super wealthy family where they couldn't find their identity. So you have this thing where you have the parents, and a lot of times they're high achievers, and you have the kids, you have the relationships. So how do you aim your resources and tailor your estate plan so that it's taking account for the individual natures of each of the kids, right? It's missed because of economics. So because lawyers are running hard just to get the documents done, from either a drafting standpoint, tax standpoint. So all of that stuff is happening without really taking account for the relationship aspect of it. And how are we going to help empower the kids to then either when they get that wealth, they're going to have values that come along with it. They're going to know what their role is and how to even think about the family wealth, because a lot of these parents, they work themselves up from the bottom, and they're disciplined about it. They know what it's like to go without. So they're very, that's their attitude. They're very shrewd about it. Kids coming up, if they didn't develop that themselves, it's not going to happen by accident. So that's really what it is. It's being able to partner with the sort of middle and upper wealthy families to say, okay, do you have a plan for the third component? Because I mentioned the three, right? I mentioned your systems, your tax efficiency, and your people. And there's people like Ted Hughes is one. They've written books about this, and so they know that the value, especially for a wealthy family, the value of your family is really in its people. And there's a rule of three. A lot of wealthy families lose all their wealth within 3 generations. And this is known very well throughout the world. This is not just in the US. This is in Asia. They talk about it like 3 generations from rice paddy to rice paddy, kind of things. And so this is about the integrity and the values. You talk about a family constitution. You talk about family values and trying to help families thrive from generation to generation, which is really at the root of this. And I know it's higher level. This is, if you don't have a lot of wealth and you're listening, this is still good, because think about your family, think about your loved ones, think about how to mentor future generations. And if you're a young person just starting a policy, imagine what you want that to grow into, and how that can become extremely meaningful later, when you not only have the financial asset backing of that, but you also have some idea about instilling values in your kids, grandkids, whatever. So that's what we hope to impart with that. So.
That makes a lot of sense, and the human element of a family is really its true form of wealth, and without that connection to your kids and understanding and educating them and making sure they understand they're part of a bigger system, an ecosystem, like we were saying earlier,
Yes.
everything else is lost. And I think it's a really important lesson that we can kind of leave everyone with. It's just don't neglect the people, because as soon as you do that, everything else becomes meaningless. And
Right.
unfortunately, for a lot of people out there, they don't realize until it's too late. So if you're out there listening to this, then this is the point in time which you need to really lock that in. I just want to close this out. We're coming up on time here, and I want to close this out with a question for you that sort of kind of summarizes everything that we've been talking about here. So if there was a father out there who wants to build generational wealth for his family, and he's thinking about it long term, like he's a steward of the wealth that he has now, and he wants to hand it over to the next generation. What's one question or a principle that should guide every major estate decision?
Mm. It's a very deep question. And if I have to distill it down to one thing, I'm going to say at a young age, if you can get clear about what your vision is for your family, your loved ones, which by the way, this transcends everything, right? For a guy my age, there's certain things I would have done completely differently at a young age. And I didn't have, and I probably enough of that where somebody would sit me down and say, I want you to think about being very deliberate with the things that you do. I want you to chart a course for yourself. It doesn't mean everything is going to go perfect, but it's going to go better. I guess there's a biblical reference, without a vision, the people perish, that kind of thing. Um, and we have a book that my partner did. It was called Kingdom Money, and it has to do with sort of principles around this sort of spiritual view of your life, right? And so I would say give it some thought and get very clear, and then think about those three different systems that you're building. You're building a structure, which is could be documents, it could be a strategy. You're building your financial efficiency piece, and you're also building up your people. And that one resonates, right? People go through marriages, they go through all kinds of bad choices. But if someone, especially a young guy, I'm thinking about young guys, sit them down and say, I want you to be very intentional about what you want to build with your life. Because you can't just shoot through life without thinking and think it's just gonna, I mean, you have to have some compass, right? Some bearings. So,
I think it's a really, really good note to leave it on, and that can also apply to our children as well. Like I frequently will sit down with my kids and talk about not only the vision that I have for the family, but that they are part of it, and that they need to think about. They're very young, but that they need to think about the future, and hopefully by getting into them young, they don't make the same mistakes I did. I did in my
right.
early 20s.
That's right.
But
I
Steve, I
think
want to
that's
thank you for coming
part of
on today. I really enjoyed our talk.
it. I loved it. I appreciated it. And it's great to be here with you.
I learned a lot from Steve in this episode, and I hope you did as well. Insurance and Estates, Steve's company, is part of the Dynesis Network, and you can connect with Steve with the link in the description down below. For more on the human element of your family and how to build greatness among your ranks, I did an episode with Nick Muniz that you can check out over here. Or if you want to be around long enough to enjoy what you've built, then there is an episode that I did with Dave Pascoe, one of the leading men on longevity in the world, that you can check out over here. And those links will be in the description if you're listening. Remember, a like and subscribe goes a long way to helping me bring more great guests to you, and not to mention it's very appreciated. And speaking of appreciation, I want to say thank you for joining me for this episode today, and I will see you in the next one. Bye for now.